In this video, we are going to tell you some crucial money concepts. As long as you master some of these important concepts early on, you'll be well on your way to being wealthy. Learning them at a young age will make it exponentially easier for you to be extremely well off, whereas those who never learn will struggle to be wealthy. They will be in a permanent state of struggle because these are significant sums of money. Concepts to learn as soon as possible, then stay until the end to hear one concept that will radically shift the way you think about money. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. Short net worth is a measure of your financial health, and while it may not present the complete picture, it does provide fantastic insight into your condition. The total value of everything you own, plus the value of all bank accounts, retirement accounts, and anything else in your name, less any debt you owe, equals your net worth. Beginning to track this statistic at a young age and keeping an eye on any changes can be extremely beneficial because you can quickly see your progress over time that would otherwise be difficult to see in the near term. You're in a good place if your net worth is positive, but many people find that their net worth is negative and they have a lot of work to do. Keeping track of your net worth is immensely beneficial. Net worth, so you can see progress from year to year when it can feel like you're not making any progress from day-to-day inflation. Most people understand that inflation causes the purchasing power of the dollar to decrease, but there's more to this than isn't considered. Is that when the price of goods rises, the dollar doesn't go nearly as far as it should. When inflation is 5% per year, the dollar only has 95% of its worth after 1 year, and the value of a dollar is cut in half in around 14 years. You must be conscious of the effect this has on your income when it comes time to negotiate your pay. When your boss acts as if they're doing you a favor by giving you a 3% raise every year when inflation is 5%, you're essentially getting a pay cut of about 2%. In this case, a 5% pay adjustment doesn't even mean an increase in pay. A savings account that pays 3% interest when inflation is 5% means you've lost 2% of its purchasing power over the course of a year. This isn't a big deal for small amounts of money over short periods of time, but it is something you should consider for long periods of time liquidity. When determining where to invest your money, you should consider liquidity or how easily available that money will be. Cash or money in a bank account is particularly liquid since you can get to it quickly and readily at no cost. Retirement accounts have numerous advantages, but liquidity is not one of them. A 401k or IRA is not designed to be taken until you reach retirement age, and you will be charged fees if you take it out while you are still young. Additionally, you risk losing money if you withdraw from investments while you are still young. That fluctuates significantly in value is wonderful for investing money. The money is essentially inaccessible in the short term, so make sure you have adequate savings in place so you don't need to cash out anytime soon. When it comes to saving money, interest is a double-edged sword that you must grasp. Earning interest implies your money is working for you, which is obviously a good thing. When you borrow money, you pay interest to the lender in exchange for the ability to use their money. This can be good or bad depending on the circumstances. In general, paying interest isn't a bad thing if it allows you to generate more income than you're paying in interest. For example, an investor would be happy to borrow money at 5% interest to purchase a rental property that will offer them a 10% return on their investment. A car buyer may choose to finance the vehicle at 0% interest and invest the lump sum instead. The borrower does not mind paying interest in this circumstance because it is still profitable to them. It is obvious that paying high interest rates is unwise, yet some types of low-interest loans might potentially benefit you. Interest on interest. Albert Einstein famously stated that compound interest is the world's eighth wonder. He who knows it earns it, while he who does not pays it. The amazing thing about compound interest is that when you invest your money, it grows exponentially, and it becomes easier and easier to build wealth with each passing year. You earn interest on the interest you earned previously. The result of investing over an extended period of time is that the majority of the funds are interest earned while only a small percentage is what you earned and saved. It is not essential to work and save millions of dollars for retirement when compound interest will do the heavy lifting for you. If more people understood this incredible concept, no doubt more people would use it and begin saving even a small amount of money on a regular basis. Crashing markets. Market collapses are a common event and should not be taken seriously. However, whenever one occurs, panicky investors lock in losses by selling everything. Stock market collapses or bear markets occur when prices drop 20% from their all-time highs. Highs are rather common and should be expected by investors from time to time. It is best to be aware of these situations before investing large sums of money to avoid reacting. With a high risk tolerance, a market crisis may delight them because they perceive it as an opportunity to be more aggressive with their investments. Risk-averse individuals are less active and may be discouraged from investing entirely. Risk tolerance is determined by how much time you have to invest based on criteria such as your age and projected earnings. When investing in the S&P 500, too much risk might result in a total loss, while too little risk can result in a loss of compound interest. An individual should be aware that the price lowers by 20% or more every 4.5 years on average. Funds or an S&P 500 fund to land somewhere in the middle. The time value of money is the concept that money today is worth more than money tomorrow. A dollar earned today will not be the same as a dollar earned in the future because it could have been invested to grow and compound when you have two options: spend it or invest it so that it will grow. These important money concepts aren't difficult to understand, but the earlier you develop an understanding of these concepts, you'll be in better shape. You don't want to be old and exhausted, wishing you had known these things when you were younger. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?